Here is something the credit system never tells you directly. A person with $50,000 in savings and zero debt can have a lower credit score than a person with zero savings and 3 active loan balances. That is not a glitch. That is how the model was designed. And once you understand why, the entire credit scoring system looks completely different. Most people treat their credit score as a measure of financial health. The higher the score, the better you are managing your money. The lower the score, the more financial trouble you are in. That framing is understandable. It is also fundamentally inaccurate. Your credit score does not measure your financial health. It measures your predicted value as a borrower. Those two things sometimes correlate, but they are not the same thing. And when they diverge, the scoring model does not hesitate to prioritize the second over the first. A person who has never missed a payment, carries significant savings, earns a stable income, and has paid off all their debt, is less attractive to the credit scoring model than a person who carries multiple active credit accounts, maintains low but non-zero utilization rates, and has a long history of making minimum payments on revolving debt. The second person is more profitable for lenders. The scoring model was designed by and for lenders. It reflects their interests accurately. By the end of this video, you will understand exactly how the model is constructed, what it was actually designed to predict, and how to navigate it intelligently without allowing it to trap you into maintaining debt you do not need. Let us start with what is actually inside the number. The dominant credit scoring model in the United States is called the FICO score. It was developed by the Fair Isaac Corporation, now simply called FICO, and has been the primary credit scoring model used by most lenders for several decades. The score ranges from 300 to 850. It is calculated from 5 categories of information drawn from your credit report. Payment history accounts for approximately 35% of the score. This is the largest single factor, and it is the one most aligned with what people intuitively think a credit score measures. Have you paid your bills on time? Amounts owed, commonly called credit utilization, accounts for approximately 30%. This factor measures how much of your available credit you are currently using. And here is where the model starts diverging from what most people expect. Zero utilization, meaning you have available credit but are using none of it, is not optimal for your score. The model actually prefers a utilization rate of approximately 1 to 10%, meaning carrying a small active balance is better for your score than carrying no balance. Length of credit history accounts for approximately 15%. Longer histories score better, which means closing old accounts, even paid off ones you no longer use, can hurt your score by shortening your average account age. Credit mix accounts for approximately 10%. This factor rewards having multiple types of credit, installment loans like a mortgage or car loan alongside revolving credit like a credit card. A person with only one type of credit account scores lower than a person with multiple types. The model rewards complexity of debt, having more kinds of debt, not just more responsible management. New credit accounts for approximately 10%. Opening too many new accounts in a short period hurts the score. Now step back and look at what this model rewards. Long history of active accounts with regular payments. Multiple types of credit products. Low, but non-zero utilization of revolving credit. What does a person with all of these characteristics look like? They look like a borrower who has been regularly using credit products for a long time, keeps active balances, and has borrowed across multiple product categories. That is the ideal FICO customer. That is also a significantly more profitable customer for lenders than someone who has saved carefully, borrowed rarely, and paid everything off quickly. The model does not reward being financially independent. It rewards being a consistent, engaged, ongoing participant in the credit economy. Now let us go deeper into what the FICO model was actually built to do, because understanding the design intent clarifies everything about why the model works the way it does. FICO was not designed to answer the question, is this person financially healthy? It was designed to answer a very specific, different question. What is the probability that this person will miss a payment in the next 24 months? That is the question lenders need answered before extending credit. And the FICO model, designed with lender data and lender input over decades of refinement, answers it with reasonable statistical accuracy. But here's what answering that question required: building a model that scores highest for people who have a long, consistent history of making payments on multiple credit products, because that is exactly the profile of a person statistically unlikely to miss a payment in the next 2 years. A person with no credit history does not have a low score because they are financially irresponsible. They have a low score because there is no data from which to make the statistical prediction the model was designed to produce. They are not risky. They are unscored, which, from the lender's perspective, amounts to the same problem. Now consider who benefits from this design. Lenders benefit because the model reliably identifies borrowers who will keep paying, but lenders also benefit from a secondary effect that does not appear in the official description of what FICO measures. The model creates a structural incentive for consumers to maintain active credit accounts to protect their score. Think about what that means. In practice, a consumer who understands that closing old accounts hurts their score keeps those accounts open, potentially including accounts that carry annual fees or that occasionally tempt spending they would not otherwise make. A consumer who understands that zero credit utilization is suboptimal maintains a small revolving balance, which generates interest revenue for the issuing bank. A consumer who understands that credit mix improves the score may be motivated to add additional credit products to their portfolio, which creates new customer relationships for lenders. The scoring model, in its design, creates behavioral incentives that systematically drive consumers toward more credit product engagement than pure financial optimization would require. This is not explicitly stated as a design goal, but it is a predictable, documented consequence of how the model is structured. And here is the reinforcing loop that makes it durable. The credit score is used for more than just lending decisions. Employers use it in background checks. Landlords use it to screen tenants. Insurance companies use it to set premiums. Utility companies use it to set deposit requirements. The score's pervasive use across domains that have nothing to do with lending, job applications, housing, insurance, means consumers have strong non-lending incentives to protect a high score, which means they have strong non-lending incentives to maintain the borrowing behaviors the model rewards. The credit score is no longer just a lending tool. It has become a behavioral governance mechanism that shapes financial decisions across domains far beyond the credit products it was originally designed to evaluate. And almost none of this is explained when you are handed your first credit card and told to build credit. If understanding what the credit score was actually designed to measure just changed how you see the number on your own report, stay with me. Because understanding the design intent is one thing. Understanding the specific ways that zero debt can hurt your score and how to navigate the system intelligently without being trapped by it, that is what comes next. Let us make the zero debt scoring paradox completely concrete. Here is a real scenario that plays out for thousands of people every year. A person spends several years aggressively paying off debt. Credit cards cleared, car loan paid off, student loans eliminated. They feel an enormous sense of financial accomplishment because financially, they have accomplished something enormous. Their net worth just improved significantly. Their monthly cash flow improved significantly. Their financial resilience improved significantly. And then they check their credit score. It is lower than it was during the years they were carrying debt. Here is specifically what happened. Their credit utilization ratio dropped to 0, which the model treats as slightly suboptimal compared to a low but non-zero ratio. If they closed the credit card accounts after paying them off, which feels like the natural thing to do, their average account age dropped, reducing the length of credit history factor. If those credit cards were their only revolving credit accounts, their credit mix changed, losing the revolving credit component that the model rewards. In total, a person could execute a financially excellent series of decisions, paying off all debt, achieving zero financial obligations, and see their credit score decline across multiple factors simultaneously. Now consider the practical consequences. They want to rent an apartment. The landlord checks the score. The number is lower than expected for someone in their financial position. The landlord does not see the paid-off debt or the growing savings account. They see a score that does not tell the story of what actually happened. This is not a theoretical problem. It is a documented, common experience for people who achieve genuine financial independence from debt, only to find that the primary system used to evaluate their financial trustworthiness In most major financial and life decisions rates them lower for achieving it. The system sends a clear behavioral signal. Stay engaged with credit products, maintain active accounts, carry manageable balances. Do not fully disengage from the credit economy we built to evaluate you. That signal is not accidental. It is structural. And understanding it clearly changes how you interact with the system, without allowing the system to dictate your actual financial behavior. Here is the practical framework for navigating the credit score system intelligently. First, understand what you actually need a high score for. The credit score matters most at specific decision points: a mortgage application, a car loan, renting an apartment in a competitive market, certain employment background checks. At those moments, the score matters. Between those moments, optimizing it at the expense of your actual financial health is misaligned with your real interests. Second, keep accounts open even after you pay them off. Do not close old credit card accounts. Leave them open with zero balance or a tiny recurring charge paid off monthly. This maintains account age and credit utilization without carrying meaningful debt. Third, maintain minimal revolving utilization without carrying a balance. Put a small recurring charge, a streaming subscription, a monthly utility, on a credit card. Pay it in full every month. This keeps utilization above zero without generating interest charges. Your score stays healthy. Your actual debt is zero. Fourth, do not open new accounts close to a major application. New credit inquiries temporarily reduce the score for up to a year. Plan major credit applications at least 6 months after any new account openings. Fifth, monitor your report for errors. 1 in 5 credit reports contains an error, according to research by the Federal Trade Commission. Errors that lower your score without reflecting your actual behavior are disputable and correctable. Dispute them. The credit score system was built to serve lenders. Understanding that does not mean ignoring the score. It means managing it with minimum engagement, doing the specific things that protect it when you need it, while building your actual financial position independently of what the score incentivizes. The score is a tool you use when you need it, not a master you serve permanently. Your credit score does not measure your financial health. It measures how valuable you are as a borrower to the institutions that designed it. Understanding that distinction does not mean ignoring the score. A high score is a useful tool at specific moments in your financial life. It means knowing what the score is actually optimizing for and making sure that optimization serves your interests rather than capturing you in a permanent cycle of managed debt. Share this with one person who has been afraid to pay off a credit card because they heard it might hurt their score. And if you want to keep understanding the financial tools that were built around someone else's interests, subscribe to Hidden Truth Files. Hidden, no more.